Vanakkam, Namaskar, and hello to all the listeners of this edition of Fixed Income Markets with Sundar Mutual Fund. This edition seems like a continuation of the last edition, with MPC hiking the repo rate again by 50 basis point after a hike of 40 basis point to take the repo rate to 4.9%. Consequently, the standing deposit facility, which is the floor rate, gets revised to 4.65%, while the ceiling rate, which is the margin standing facility, gets revised to 5.15%. And the liquidity adjustment facility corridor remains at 50 basis point, 25 basis point each from the repo rate. This is on back of sustained inflationary pressures emanating largely from the supply side issues. A prolonged conflict situation between Russia and Ukraine is keeping supply of oil, fertilizers, and grains from coming to the global supply chain, resulting in sharp rise in prices of these key commodities. And also now with China opening up post coronavirus outbreak in some major cities, the demand for commodities is rising from China as well, putting further pressure on prices. India being a net importer, the demand for commodities like coal, oil, semiconductor, chips, edible oils, etc., is pushing the import bill northward despite a healthy export growth. We have now a run rate of close to, on the trade deficit, close to about 20 billion US dollars, and this is looking to increase in the next few months before the higher prices sap demand. Considering this background and the nature of these imports, this is likely to put pressure on the current account deficit, and with global tightening cycle in play, where the all major central banks in developed economies are raising rates and withdrawing easy liquidity, very low chances of any appreciable capital flows into the country in the near term, and which can result in the balance of payment to be in deficit, which might need a dip into the forex reserves. Incidentally, the forex reserves stand at a healthy level of about over 600 billion, and taking the forward book of RBI into account in a vicinity of 40 to 50 billion, we are ready to face or weather any storm which is looking us in the face at this point in time. In this backdrop, it is imperative for the Monetary Policy Committee to keep the rupee supported by keeping pace with the global tightening cycle, even if that means sacrificing growth in the near term. An anchor on inflation expectation is very essential to have a sustained growth in the future. Monetary Policy Committee has been cognizant of the nascent recovery and has tried to balance the difficult circumstances by keeping a focus on withdrawal of accommodation over a multi-year period, keeping in mind the objective of growth by supplying credit to productive sectors of the economy. Overall, the liquidity overhang in the system has been coming down, and it is now about 3 lakh crores from a level of about 5 lakh odd crores. But the durable liquidity in the system continues to be over 7 lakh odd crores. If the inflationary pressures persist, we might see RBI withdrawing this liquidity at a faster pace than what they have indicated. The higher fiscal deficit, which sustains supply side pressure and global commodity prices, has resulted in raising inflationary expectation on account of feedback mechanism between the current account and fiscal account. In order to stave off any shock, Monetary Policy Committee has to be alert of any fallout of any future unfolding of event on the global front. Now, having set the context, it is important to examine the current shape of the yield curve and our expectation from that. So what we can see in the current shape of the yield curve is that the shorter end is still lower than the longer end. This is largely emanating from the fact that liquidity on the shorter end is pretty good, and still the operative rate is the standing deposit facility, which is lower than the repo rate. And this is keeping the curve a little steeper. And the longer end of the curve is discounting a full rate hike cycle, and market is right now projecting a terminal repo rate of anywhere between 6 to 6.5% to be delivered by the fiscal end. Again, when we look at this curve and we try, so let us look at this curve and we try to understand the curve with an example. So let us take an example of a NABARD bond in various tenors. So let us take this example and we all the yields which I am quoting are annualized yield. So it's a AAA NABARD bond. In 1 year, it is trading at about 6.4%. 2 year, it is trading at about 6.85%. 3 year, it is trading at about 7.35%. 5 year, it is trading at about 7.65%. To compute the margin of safety, one has to look uh, at the curve and define an investment horizon. So say for example, we say that we want to understand that what is the kind of return which I can get over the next 6 months, and I want to get a return which is at least the 6 month treasury bill return, which is currently trading at about 5.6%. From the yield levels where I have explained to you, if I try to work it out, adjusting to duration in the various buckets, what I understand at this point in time is that if I want to deliver a return of at least 5.6%, what is the yield rise which will take it to 5.6%, and anything beyond that yield rise, the return will fall further. So computing in this way gives us the margin of safety available and understanding of the curve going forward and which tenors to invest in. So in a one year duration bucket, if I look at it in a NABARD bond, the margin of safety available from the way I have explained to you to look at it is 89 basis point. In the 2 year tenor, it is 71 basis point. 3 year, it is 65 basis point. In 5 year, it is 55 basis point. Extrapolating this logic into the portfolios which we invest in, we can understand that we can take them as duration buckets. Like example, in Ultra, it is 3 month to 6 month, and define an investment horizon. And depending on the duration bucket, we can understand what kind of return expectation we can have, and we can extrapolate it in a similar exercise which we have done on a single bond can be done on a portfolio basis, and try to understand that what is the kind of return expectation which we can have if this is the given circumstances, and what is it also can be dovetailed with our expectation on the interest rate rise in the similar period, and we can understand that whether we should be investing in that bucket or not. Considering that, I think people who are staying too low on a, who have a longer horizon of say 6 month or 12 month or maybe even 18 months or uh, uh, longer investment horizon, they can move up the curve, trying to understand what kind of yield rise could happen in the coming time, again from the expectation of inflation projection, which again RBI has revised upward by about 1%. Earlier policy the inflation expectation 1 year ahead was 5.7, and now they have revised it to 6.7%, which is about a percent higher. So clearly, what we can expect in this point in time is that the repo rate would, to make it take it to a neutral level, has to go to about 6.5% level. So clearly, the investor can wait to deploy money in longer buckets where the duration is longer and the margin of safety is lower, while they can definitely invest if they have longer horizons. If their return is better than the shorter buckets, they can move up the curve and invest their monies in some roll down products or match their duration to the products. So that is how investment can be taken care of in fixed income market at this current juncture. Thanking you all for listening to this edition and looking forward to having you all in the next edition. Thanks a lot.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.